Hello, my name is Victor, and in today's video, I want to go over the earnings of two tech titans, Meta and Google. And Meta has been falling off of a cliff here ever since their earnings, so I want to discuss what happened, what was said, was it a specific number in the report itself, and I want to go over Google, who has been reaching the stratosphere over the last year, really. But I want to go over why they're doing so well and compare it to what Meta is doing wrong, in my opinion. But let's not waste any time. Let's get right into Meta's income statement and analyze what happened. And we are going to start top to bottom here. Meta's income statement analysis here for you. We can see that revenue was up 30% compared to this time last year. Very strong number. But then we're going to go down here to the cost of revenue, and that was up 35%. So already big red mark because that's already higher than the revenue. But as we go down, research and development was up a staggering 46%. Again, not what I want to see when all of these percentages in terms of costs are higher than the revenue top line. But keeping it going here, marketing and sales up 6%. That's not too bad, kept in line. G&A up 15%. So operating income came in at plus 30% compared to this time last year, which is a strong number, but I generally like to see that the operating income is higher than that top line. And we're going to come back to this highlighted section here in just a moment, but the net income for the quarter came in positive 61%, which looks amazing. But like I had mentioned, we're going to come back to this highlighted section here because Meta had a benefit, a one-time addition here of $5 billion, which really helped out that net income. So really, if it hadn't been for that, the net income would not have looked as good as it does right now. And I am immediately starting to think that Meta's CapEx spending over the last year is really starting to catch up to them looking at these numbers, because the cost of revenue, the percentage growth for some of these numbers is far outpacing that top line now. And unfortunately for Meta, that might only be getting worse. And that is because Meta has advised that they are going to increase the CapEx spend even more than they had originally stated. In this most recent 10Q, they are saying that they're going to increase CapEx spend to $125 billion to $145 billion throughout 2026. Now, originally, those numbers were $115 billion to about $135 billion. So quite the jump here. And let me tell you right off the bat that Wall Street was not a fan of this increase to CapEx spend, because Meta is down 9% over the past week. But okay, that was Meta's income statement. Now let's have a look at Google's income statement and analyze what they did either right or wrong and compare it to Meta. But looking here at Google's income statement, we can see that revenue was up 22%, not as strong as Meta, but still a very strong double-digit number. Cost of revenue was up 14%, R&D was up 26%, sales and marketing up 23%, G&A up 21%. So the total cost of expenses was up 18%. Now remember, I want to see the operating income higher than the revenue top line. For Google, their operating income came in at positive 30% compared to this time last year. So they did have increases in their spending, but they were able to keep it in line compared to that top line. And that is exactly what I want to see as an investor of a company, especially these big tech companies, because I want to see some strong margins, because normally tech stocks tend to trade at a premium. There is a line here that stood out to me, and that is other income, which was up 237% compared to this time last year. After I did some digging, it looks like it was because of foreign currency exchanges, but mostly because of private investments. So marketable securities and the like. And just like I had discussed with Amazon last quarter, I am not going to be upset if a stock has booming net income because of prudent or wise investments on their part. And that is exactly what Google is doing here, or what they did do over this most recent quarter. And with that, they had net income up 81% compared to this time last year. So exactly what I wanted to see from Google. Strong 20 plus clip on the top line, and even stronger operating income, 30%. And it's all making its way down to the bottom line, up over 80%. What's not to like about these earnings? I mean, absolutely amazing stuff from Google over this past quarter. Now, it's not all sunshine and rainbows though for Google, because just like Meta, they also announced that they're going to be increasing their CapEx spend for 2026. That increase is looking to be in a range about $180 billion to $190 billion, again, through the end of 2026. Originally, that range was closer to $175 billion to $185 billion. So not as drastic of an increase like Meta, but they did still increase that CapEx spend. So just like Meta, did Wall Street absolutely punish Google for this update? Not at all, actually, quite the contrary. And that is because, unlike Meta, Google actually gives you a breakdown of their revenue. And we can see that here. You can see that Google search and other was up 19%. YouTube ads were up 11%. Google network was down, but only about 4%. So I'm not going to really, harp on that, especially as we go down the line here, because Google advertising was up 16%. Google subscriptions, platforms, and devices up 19%. Google services total was up 16%. And here's the most important number that all of Wall Street wanted to see. Google Cloud. So AI, where all of this CapEx spending is going to, Google Cloud was up 63% compared to this time last year. I mean... And just like we had mentioned before, so total revenue's up 22%, and they give you line by line how everything is performing, and especially being able to see that Google Cloud number, that is what Wall Street wants to see. So while yes, they did increase the CapEx spend, they're growing the Google Cloud by so much that AI and infrastructure and all of that spending, they have something to show for it. And again, that is unlike Meta, who just gives you the top line. And while yes, it is very impressive, up 30%, but we want to see some transparency. How is that money being utilized? Is there a specific AI number that you can show us that is growing so that we can be like, okay, yeah, they're spending like crazy, but we're seeing returns from that investment. Google is able to provide that for investors, and Meta is not doing so. And that is why Meta has been crushed over time. And thanks to Google's transparency, being able to see that Google Cloud number up by so much, being able to tell investors, hey, look, yes, we're spending like mad, but as you can see by this number, we're seeing a return on that investment. That transparency is the biggest difference between Meta and Google right now. So while Meta was down 9% over the last week, Google was up 11% over the last week. It is a tale of two tech giants here in the stock market, because both of them are investing in AI like crazy. But one stock, one CEO is doing much better in terms of being able to explain the story to investors, whereas Mark Zuckerberg, because I listened to the conference call, and Mark Zuckerberg kind of brushed off questions of like, basically saying, yes, of course we're spending, we're a tech company, we have to invest to grow. And while yes, I do understand that, and I have agreed with that statement before on the channel, I would love to see a level of transparency like Google does. Break down that revenue, show us exactly where everything is going so that we have a better understanding and we can see the bigger picture for Meta. Now, will Mark Zuckerberg be willing to do that? Is he even able to do that? I don't know. I can't answer those questions. It's just something that I would hope to see maybe over the next year, because so long as Meta keeps spending like a drunken sailor and cannot explain or cannot show any results of that spending, Wall Street is not going to be about any of these CapEx increases, especially because it looks like it is not slowing down. If anything, it seems like Mark Zuckerberg is hitting the gas even more as we get deeper into 2026. And I know some of you might not care about this part, but I do, and that is why I'm going to include it in this video. I have a Google dividend update because Google did increase that dividend by 5%, now paying a total dividend annual amount of 88 cents per share. Now, just like I had mentioned in my Johnson & Johnson video, this is pretty much what I had expected. I had lowered my expectations of dividend increases, at least throughout this year, to 3 to 5% for every single company. It just seems to me like everybody is hopping on the bandwagon of there's a lot of risks in the world right now, so we're going to be a little bit more conservative and grow the dividend by a slower amount, which is fine, I guess. But I just want to highlight for Google specifically that they barely started paying that dividend. To be fair, they've only been paying that dividend for about 3 years, so I have a 3-year dividend CAGR, compound annual growth rate, for Google's dividend of 3.2%. So I guess it's keeping up with inflation, you could say. It's not really the most impressive dividend, but what's probably more important to me is this next part here, and that is that Google has a dividend payout ratio of about 8%. Generally, anything under 50% for a payout ratio is what I want to see. Anything under 25, and I want to see that dividend growing at least 7 to 8% every single year, because you have the room to grow it. But with Google and the way they are handling AI and just how fast that stock has been climbing over the past year, I can't even complain, honestly. I cannot complain about a slow dividend growth when they're doing such an amazing job with every other part of the company. And to drive that point home, I have this image here for you, which is a stock chart of Meta and Google. And as you can see, I'm telling you, it is a tale of two tech stocks, because Meta is up 11% over the last year, which for Meta is terrible. That is barely keeping up with the S&P 500 in my opinion. I want to see far better returns. I'm talking at least double that, and that's the minimum that I want to see from Meta, despite all of the risks going on in the world right now. On the other hand, we have Google, who is up 144% over the last year. I mean, absolute congratulations are in order to everybody else who is an investor in Google stock, because you have over doubled your money over the last year. Some people wait, like 7, 8 years to double their money on a stock, and here Google did it in less than a year. So yeah, it just goes to show the difference that transparency in the revenue is making for Google. Again, in my opinion, if you disagree, if you think it's another reason or there's some alternative explanation for why Google is doing so much better than Meta, please let me know in the comments below. But yeah, I mean, I just wanted to see a visual of how big the difference is, and it is an absolute chasm of a difference. Google is in an absolute different playing field compared to Meta right now. Now, having said that, I am still buying Meta here at these prices, and I have this chart that shows you exactly when I have been buying throughout 2026. In about mid-March, I was buying at $610 a share. And then that's when all of the geopolitical risks and all of the madness started to happen with all of the gasoline prices, wink wink. But at the end of March, early April is when I was really getting some good prices on Meta. I was buying in the $560 range for those shares. Now, Meta obviously has recouped a lot of their gains that they had lost because of all of that madness going on in the world. But after these earnings, Meta was down 9 to 10%, and Meta's still my number one biggest position in my portfolio. But just like I was buying Google when they were kicked and down and everybody was doubting them, I don't doubt Mark Zuckerberg. I still think that he has a plan in place. Maybe he's not as transparent, and he really never has been. He tends to go on these massive spending sprees and just doesn't explain why or how. But needless to say, I still trust Mark Zuckerberg. He is absolutely invested in the best outcome for Meta. I do not doubt that for a second. And that is why, in my opinion, Meta at these lower prices again is a buy. Anything under $625, I will continue to buy Meta and build up my position. And that's what I did this past week because again, I bought here at the very last day of April. $602 is what I paid for those shares. And if Meta continues to stay under that $625 range, I will continue to build up my position. If you made it until this point in the video, be sure to give me a like. It helps out tremendously. And as always, a massive thank you to my subscribers. I'm going to continue making these earnings analysis videos throughout the next couple of weeks. So if you do not want to miss out on any of these videos, be sure to subscribe. And as always, I'll catch you in the next one. Peace.